Introduction to Distressed Property Investing. Investing in distressed properties involves acquiring real estate assets that are typically undervalued due to various financial or physical challenges. These properties often include foreclosures, short sales, or properties requiring significant repairs. The goal is to purchase these assets below market value, rehabilitate them, and then sell or rent them for a profit. This strategy can offer substantial returns, but also carries inherent risks that require careful consideration and due diligence. Understanding the distressed property market is crucial for mitigating these risks and maximizing potential gains. Distressed properties can arise from a multitude of circumstances, such as homeowner financial difficulties, divorce, probate, or neglected maintenance. These situations often create motivated sellers who prioritize a quick sale over achieving top market price. For investors, this presents an opportunity to acquire properties at a discount, provided they have the expertise and resources to address the underlying issues. A solid understanding of market dynamics and property conditions is paramount for success in this niche. Why invest in distressed properties? Investing in distressed properties offers several compelling advantages for those seeking higher returns in real estate. The primary benefit is the potential to acquire properties significantly below market value, creating immediate equity upon purchase. This built-in equity provides a buffer against market fluctuations and enhances profitability. Additionally, the ability to add value through renovation further increases the property's worth, leading to substantial capital appreciation. This strategy is particularly attractive in competitive markets where traditional properties are often overpriced. Another key reason to consider distressed properties is the reduced competition from typical home buyers. Many distressed properties are not move-in ready, deterring buyers looking for turnkey homes. This allows investors to negotiate more favorable terms and often acquire properties without bidding wars. Furthermore, the diverse range of distressed situations means there are always new opportunities emerging, providing a continuous supply of potential investments. This niche market rewards investors who are prepared to undertake renovation and navigate complex transactions. Risks of distressed property investing. While profitable, investing in distressed properties comes with significant risks that beginners must understand. One major risk is underestimating renovation costs and timelines. Distressed properties often hide extensive damage, such as structural issues, mold, or outdated systems, which can lead to budget overruns and project delays. Unforeseen expenses can quickly erode potential profits, turning a promising investment into a financial burden. Thorough property inspection and a contingency budget are essential to mitigate this risk effectively. Another critical risk involves legal and title complications. Distressed properties may have multiple lines, unpaid taxes, or complex ownership disputes that can delay or even invalidate a sale. Navigating these legal intricacies requires expert legal counsel and meticulous due diligence to ensure a clear title. Market fluctuations also pose a risk. A downturn in the real estate market after acquisition can diminish property value, making it difficult to sell for a profit. Investors must be prepared for these challenges and have robust strategies in place. Types of distressed properties. Foreclosures. Foreclosures represent a significant category of distressed properties, occurring when a homeowner fails to make mortgage payments, leading the lender to repossess and sell the property. These properties can be acquired at various stages: pre-foreclosure, auction, or as bank-owned REO properties. Pre-foreclosures offer the opportunity to negotiate directly with the homeowner before the property goes to auction, potentially securing a better deal. This stage allows for more thorough inspections and a smoother transaction process, as the homeowner is often motivated to avoid foreclosure on their credit record. Purchasing at a foreclosure auction typically involves buying the property as is, with little to no opportunity for inspection. This method requires significant cash reserves and a deep understanding of local auction rules and potential hidden liens. The risks are higher due to the lack of due diligence, but the potential for a substantial discount is also greater. Investors must conduct extensive research on the property's title and condition beforehand. Relying on external information and drive-by assessments, understanding the specific nuances of each foreclosure stage is vital for successful investment. Types of distressed properties. Short sales. Short sales occur when a homeowner sells their property for less than the outstanding mortgage balance, with the lender's approval. This situation typically arises when the homeowner faces financial hardship and cannot afford their mortgage payments, and the property's value has declined. For investors, short sales can present an opportunity to acquire properties below market value, as the lender is often willing to accept a loss to avoid the lengthy and costly foreclosure process. The negotiation process in a short sale is complex, involving both the homeowner and the lender. The short sale process can be protracted, often taking several months to complete due to the lender's approval requirements. Lenders must review the homeowner's financial situation and assess the market value before agreeing to a reduced payoff. Patience is a key virtue for investors pursuing short sales, as delays are common. While the potential for a good deal exists, investors must be prepared for a longer timeline and the possibility that the lender may reject the offer. Understanding the lender's motivations and the homeowner's circumstances is crucial for successful negotiation. Types of distressed properties. Bank-owned, REO. Bank-owned properties, also known as real estate-owned, REO, are properties that have gone through the foreclosure process and reverted to the lender because they failed to sell at auction. These properties are now owned by the bank or financial institution. For investors, REO properties often present a more straightforward acquisition process compared to short sales or pre-foreclosures. Banks are motivated to sell these assets quickly, to remove them from their balance sheets, often listing them through real estate agents specializing in REO properties. While banks typically sell REO properties as is, they may sometimes be willing to make minor repairs or offer financing incentives. The negotiation process is usually less emotional than dealing with a distressed homeowner, as investors are negotiating directly with a corporate entity. However, REO properties can sometimes be in poor condition due to neglect during the foreclosure process, requiring significant renovation. Thorough inspection and accurate repair cost estimation are crucial when considering REO investments to ensure profitability. The key advantage is often a clearer title and a more predictable closing process. Types of distressed properties. Tax lien deed sales. Tax lien and tax deed sales are another avenue for investing in distressed properties arising from unpaid property taxes. In a tax lien sale, investors purchase the lien on a property, essentially paying the delinquent taxes. The investor then earns interest on this payment, and if the homeowner fails to repay the taxes plus interest within a specified redemption period, the investor can potentially foreclose on the property and take ownership. This strategy offers a passive income stream through interest and the possibility of acquiring property at a significant discount. Tax deed sales involve purchasing the property directly from the county or municipality after the redemption period for a tax lien has expired. These properties are often sold at auction, and the winning bidder receives a tax deed, granting them ownership. The main advantage is the potential to acquire property for a fraction of its market value. However, risks include inheriting existing liens, depending on state laws, unknown property condition, and the possibility of a homeowner challenging the sale. Thorough research into local laws, property history, and title status is critical for success in tax lien and deed investing. Understanding the market, research and due diligence. Thorough market research and due diligence are the bedrock of successful distressed property investing. Before considering any property, investors must deeply understand the local real estate market. This includes analyzing comparable sales, comps, rental rates, vacancy rates, and future development plans in the target area. Identifying neighborhoods with strong growth potential, good schools, and amenities can significantly impact a property's future value. Reliable data sources, such as local MLS, county records, and real estate analytics platforms, are invaluable for this research. Due diligence extends beyond market analysis to a detailed investigation of the specific property. This involves examining the property's history, including previous sales, permits, and any known issues. Crucially, a comprehensive title search is necessary to uncover any outstanding liens, judgments, or ownership disputes that could complicate the sale. Understanding zoning regulations and potential environmental concerns is also vital. This meticulous research helps investors accurately assess a property's true value and potential risks, preventing costly surprises down the line. Identifying potential distressed properties. Identifying potential distressed properties requires a proactive and multifaceted approach. One common method is to monitor public records for notice of default filings, which indicate properties entering the pre-foreclosure stage. Local county courthouses and online public record databases are excellent resources for this information. Building relationships with local real estate agents, particularly those specializing in REO or short sales, can also provide early access to off-market deals. These agents often have direct connections with banks and motivated sellers. Driving for dollars, which involves physically driving through target neighborhoods to spot neglected or vacant properties, is another effective technique. Look for signs of distress, such as overgrown yards, boarded-up windows, deferred maintenance, or stacks of mail. Once identified, research the property owner and assess the likelihood of distress. Networking with other investors, attorneys, and contractors can also lead to valuable leads. Online platforms and specialized websites dedicated to distressed properties are also useful tools for sourcing potential investments. Networking and building a team. Successful distressed property investing is rarely a solo endeavor. It heavily relies on building a strong, reliable team. Key team members include experienced real estate agents specializing in distressed properties, real estate attorneys, and title companies. A knowledgeable agent can help identify suitable properties, negotiate deals, and navigate complex transactions. A skilled attorney is essential for conducting thorough title searches, resolving legal issues, and ensuring compliance with local regulations. A reputable title company guarantees a clear transfer of ownership. Beyond the acquisition phase, a robust network of contractors, inspectors, and lenders is crucial. A trusted general contractor is vital for accurate renovation estimates and efficient project execution. Professional home inspectors can uncover hidden defects, saving investors from costly surprises. Developing relationships with hard money lenders or private investors can provide flexible financing options for quick acquisitions. Attending local real estate investor meetups and joining online forums are excellent ways to build this invaluable network and gain insights from experienced professionals. Financing distressed property acquisitions. Securing appropriate financing is a critical step in acquiring distressed properties, and the options often differ from traditional real estate purchases. Due to the as-is condition and quick closing requirements of many distressed deals, conventional mortgages may not always be suitable. Investors often need more flexible and faster funding solutions. Understanding the various financing avenues available is essential for structuring deals that align with investment goals and property conditions. The choice of financing can significantly impact the profitability and speed of a distressed property flip or hold. Common financing methods include cash purchases, which offer the strongest negotiating position and fastest closing times. However, not all investors have sufficient capital for cash deals. Alternative options like hard money loans, private money loans, and even seller financing become crucial. Each method has its own terms, interest rates, and repayment structures, requiring careful evaluation. Some government-backed programs or specialized renovation loans might also be available for properties that meet specific criteria. A comprehensive understanding of these options allows investors to choose the most advantageous path for each unique distressed property opportunity. Traditional mortgage options. While often challenging for distressed properties, traditional mortgage options can sometimes be utilized, especially for properties that are not severely damaged or when the investor plans a long-term hold. Conventional loans, FHA loans, or VA loans typically require properties to meet certain habitability standards and pass appraisal inspections. This means that properties needing extensive repairs or those deemed uninhabitable will likely not qualify for these types of financing. However, for properties requiring only cosmetic updates or minor repairs, traditional mortgages can offer lower interest rates and longer repayment terms. Investors considering traditional mortgages for distressed properties might explore options like an FHA 203K loan or Fannie Mae home-style renovation loan. These specialized loans combine the purchase price and renovation costs into a single mortgage, allowing for financing of both acquisition and repairs. While these loans have stricter requirements and a more complex application process, they can be a viable option for owner-occupant investors or those with a clear renovation plan. It is crucial to work with lenders experienced in these specific renovation loan products. Hard money and private lenders. Hard money loans and private money loans are popular financing choices for distressed property investors due to their speed and flexibility. Hard money lenders are typically private individuals or companies that provide short-term, asset-based loans, meaning the loan is secured by the property itself rather than the borrower's creditworthiness. These loans are often used for quick acquisitions and renovations, with terms ranging from 6 months to 2 years. While interest rates are higher than traditional mortgages, the ability to close quickly and fund properties in as-is condition makes them invaluable for distressed deals. Private money lenders, often individuals or small groups, operate similarly to hard money lenders, but may offer even more flexible terms based on personal relationships and negotiation. These loans are typically sourced through an investor's personal network. Both hard and private money loans are crucial for investors who need to act fast on a distressed property opportunity, as traditional banks often cannot meet the tight deadlines. It is essential to understand the loan terms, interest rates, and repayment schedules thoroughly to ensure the project remains profitable after accounting for these higher financing costs. Creative financing strategies beyond traditional and hard money loans. Creative financing strategies can unlock opportunities in distressed property investing, especially for those with limited capital. One such strategy is seller financing, where the seller acts as the bank, providing a loan to the buyer. This can be particularly appealing to motivated sellers who want to offload a property quickly without the hassle of traditional lenders. Terms are negotiated directly between buyer and seller, offering flexibility in down payments, interest rates, and repayment schedules. This method can bypass stringent bank requirements and accelerate the transaction. Another creative approach involves lease options or rent-to-own agreements. Here, An investor leases a property with the option to purchase it at a predetermined price within a specific time frame. This allows the investor to control the property, make improvements, and potentially secure long-term financing while the property appreciates. Wholesaling, where an investor contracts to buy a distressed property and then assigns the contract to another investor for a fee, is also a creative strategy that requires no capital investment. These methods require a deep understanding of contracts and negotiation, but can be highly effective for resourceful investors. Property valuation and bidding strategies. Accurate property valuation is paramount when investing in distressed properties, as it dictates your maximum offer and potential profitability. Investors must determine the after-repair value, ARV, which is the estimated market value of the property once all necessary renovations are completed. This is typically calculated by analyzing comparable recently sold properties in the same neighborhood that are in excellent condition. A thorough comparative market analysis, CMA, is essential, focusing on similar size, age, and features. Overestimating ARV can lead to overpaying and reduced profit margins. Once the ARV is established, investors use a formula, often the 70% rule, to determine their maximum allowable offer, MAO. The 70% rule suggests that an investor should pay no more than 70% of the ARV, minus the estimated repair costs. For example, if a property's ARV is $200,000 and repairs are $30,000, the MAO would be $200,000 times 0.70 minus $30,000 equals $110,000. This rule provides a guideline, but market conditions and individual investment goals may necessitate adjustments. Strategic bidding, especially at auctions, requires discipline and adherence to your MAO to avoid emotional overbidding. Inspecting distressed properties is a critical step that cannot be overlooked, even when purchasing as is. While a full professional inspection may not always be possible before an auction, investors should conduct as thorough an assessment as circumstances allow. This involves looking for visible signs of damage, such as roof leaks, foundation cracks, water damage, mold, pest infestations, and outdated electrical or plumbing systems. These initial observations are crucial for estimating repair costs and determining the property's true condition. 1. So properties acquired through pre-foreclosure or REO, where access is granted, hiring a professional home inspector is highly recommended. A detailed inspection report will identify both major and minor issues, providing a comprehensive understanding of the property's rehabilitation needs. It is also wise to bring a trusted contractor along during inspections to get immediate estimates for potential repairs. This collaborative approach helps create a realistic budget and avoids costly surprises after closing. Never assume a distressed property's condition without attempting some form of inspection. Estimating renovation costs. Accurately estimating renovation costs is one of the most challenging yet critical aspects of distressed property investing. An underestimation can quickly wipe out profits, while an overestimation might lead to missing out on a good deal. Investors must create a detailed scope of work that outlines every repair and upgrade needed, from minor cosmetic fixes to major structural overhauls. This includes everything from roofing, plumbing, electrical, HVAC, flooring, kitchen, and bathroom remodels. Obtaining multiple bids from reputable contractors for each major component of the renovation is highly recommended. Beyond direct material and labor costs, remember to factor in soft costs and a contingency budget. Soft costs include permits, architectural fees, utility hookups, and potential holding costs, like property taxes and insurance during the renovation period. A contingency budget, typically 10 to 20% of the total renovation cost, is essential to cover unforeseen issues that inevitably arise in distressed properties. Experienced investors often keep a detailed spreadsheet of common repair costs to quickly estimate projects, but on-site contractor walkthroughs provide the most accurate figures. Precise cost estimation is the backbone of a profitable flip or rental. Legal aspects, title searches and liens. Understanding the legal aspects of distressed properties, particularly title searches and liens, is paramount to protect your investment. A title search is a comprehensive examination of public records to determine the legal ownership of a property and identify any encumbrances, such as mortgages, judgments, tax liens, or easements. These encumbrances, known as liens, are claims against the property that must typically be satisfied before a clear title can be transferred. Failing to identify and resolve these issues can result in inheriting significant financial liabilities or even losing the property. Different types of liens can affect a distressed property, including mortgage liens from previous lenders, tax liens for unpaid property taxes, mechanics liens for unpaid contractor work, judgment liens from court rulings, HOA liens for unpaid homeowner association dues. A thorough title search, usually conducted by a title company or real estate attorney, is crucial to uncover all existing liens. It is imperative to ensure that all liens are either paid off or explicitly removed from the title before closing the purchase. Title insurance is also highly recommended to protect against any unforeseen title defects that may emerge after the sale. Navigating the purchase process for distressed properties often involves unique steps compared to traditional home buying. The specific process will vary depending on the type of distressed property, whether it's a pre-foreclosure, auction, short sale, or REO. For pre-foreclosures, direct negotiation with the homeowner is key, often involving a quick cash offer to resolve their financial distress. This stage allows for more flexibility in terms and inspections. Auction purchases require bidders to be pre-qualified and have funds readily available, as sales are typically final and as is, with little to no inspection period. Short sales involve a lengthy approval process from the lender, which can take months. REO properties, being bank-owned, usually follow a more standardized real estate transaction process, but banks may have their own specific contracts and addendums. Regardless of the type, working with an experienced real estate agent and attorney who specialize in distressed properties is crucial for smoothly navigating the complexities and ensuring a successful closing. Property renovation and management. Once a distressed property is acquired, the renovation phase begins, which is critical for increasing its value. Effective project management is essential to ensure renovations are completed on time and within budget. This involves creating a detailed renovation plan, scheduling contractors, overseeing work quality, and managing material procurement. The goal is to transform the property into an attractive, market-ready asset while maximizing return on investment. Prioritize repairs that offer the highest value add, such as kitchen and bathroom remodels, and address any structural or safety issues first. For investors planning to hold the property as a rental, effective property management becomes crucial after renovation. This includes finding reliable tenants, collecting rent, handling maintenance requests, and ensuring compliance with landlord-tenant laws. Investors can choose to self-manage or hire a professional property management company. While self-management saves costs, a management company can handle day-to-day operations, especially for out-of-state investors or those with multiple properties. Efficient property management ensures a steady income stream and protects the long-term value of the investment. Contractors and project management. Selecting the right contractors is paramount for successful distressed property renovations. Begin by obtaining multiple bids from licensed and insured contractors, ensuring they have experience with similar projects. Always check references, review their previous work, and verify their credentials. A clear, detailed contract outlining the scope of work, timeline, payment schedule, and warranty information is essential to prevent misunderstandings and disputes. Communication is key. Establish regular check-ins and clear channels for updates and problem-solving. Effective project management involves more than just hiring contractors. It means actively overseeing the renovation process. Create a realistic timeline with milestones and regularly monitor progress against it. Anticipate potential delays and have contingency plans in place. Manage the budget meticulously, tracking all expenses and ensuring payments align with completed work. Quality control is also vital. Regularly inspect the work to ensure it meets agreed-upon standards and local building codes. A well-managed renovation project minimizes stress, saves money, and ensures a high-quality finished product. Exit strategy: flipping properties. Flipping properties is a popular exit strategy for distressed property investors, involving buying a property, renovating it, and then quickly reselling it for a profit. The success of a flip hinges on accurate ARV estimation, efficient renovation, and effective marketing. The goal is to minimize holding costs by completing renovations swiftly and selling the property as quickly as possible. This strategy is best suited for properties in desirable locations with strong buyer demand, where value can be added through cosmetic and functional upgrades. Key factors for a successful flip include buying significantly below market value, keeping renovation costs within budget, completing renovations quickly and efficiently, marketing the property effectively to attract buyers, pricing the property competitively for a fast sale. Investors must be prepared for market fluctuations and potential delays, which can eat into profits. A well-executed flip can generate substantial short-term returns, but it requires careful planning, a reliable team, and a keen understanding of the local real estate market. Exit strategy: rental income. Holding a distressed property as a rental is a long-term exit strategy that generates consistent passive income. After acquiring and renovating the property, investors lease it to tenants, collecting monthly rent. This strategy is ideal for properties in areas with strong rental demand, stable employment, and good amenities. The goal is to achieve positive cash flow, where rental income exceeds all property expenses, including mortgage payments, taxes, insurance, and maintenance. Rental properties also offer potential for long-term appreciation and tax benefits. Key considerations for a successful rental strategy include thorough tenant screening to find reliable renters, setting competitive rental rates based on market analysis, efficient property management for maintenance and tenant relations, maintaining a reserve fund for unexpected repairs, understanding landlord-tenant laws and regulations. While rental income provides a steady cash flow, it also requires ongoing management and can involve dealing with tenant issues or unexpected vacancies. However, for investors seeking long-term wealth building and diversification, a well-managed rental portfolio can be a highly rewarding strategy. Exit strategy: lease options. Lease options, also known as rent-to-own agreements, offer a flexible exit strategy for distressed property investors, particularly when a direct sale or traditional rental might not be immediately optimal. In a lease option, the investor, as the owner, leases the property to a tenant with an option to purchase it at a predetermined price within a specified period. The tenant typically pays an upfront, non-refundable option fee and a slightly higher monthly rent, with a portion often credited towards the purchase price if they exercise the option. This strategy appeals to tenants who aspire to home ownership but cannot qualify for a traditional mortgage immediately. For investors, lease options provide several benefits. attracting a wider pool of motivated tenants, generating higher monthly cash flow, rent plus option premium, reducing vacancy rates as tenants are invested in the property, potentially selling the property at a higher pre-agreed price, shifting some maintenance responsibilities to the tenant depending on the agreement. This strategy allows investors to generate income while waiting for market appreciation or for the tenant to secure financing. However, it requires carefully drafted legal agreements to protect both parties and a clear understanding of the terms. Lease options can be an excellent tool for maximizing returns and minimizing holding costs on certain distressed properties. Tax implications of distressed property investing. Understanding the tax implications of distressed property investing is crucial for maximizing profits and ensuring compliance. The tax treatment of your investment depends largely on your exit strategy and how the IRS classifies your activity. If you are flipping properties, profits are generally considered ordinary income and are subject to self-employment taxes, similar to a business owner. This is because flipping is often seen as an active trade or business, and the holding period is typically short. Accurate record-keeping of all income and expenses is vital for tax purposes. For properties held as rentals, the tax treatment differs. Rental income is generally reported on Schedule E, and investors can deduct various expenses, including mortgage interest, property taxes, insurance, maintenance, and depreciation. Depreciation is a significant tax benefit, allowing investors to deduct a portion of the property's value each year over its useful life, even if the property is appreciating. When selling a rental property, capital gains taxes apply, which can be long-term or short-term, depending on the holding period. Consulting with a qualified tax professional specializing in real estate is highly recommended to navigate these complexities and optimize your tax strategy. Building a sustainable investing business. Building a sustainable distressed property investing business requires more than just individual successful deals. It demands a strategic, long-term vision. This involves continuously refining your acquisition criteria, expanding your network, and automating processes where possible. Developing a strong brand and reputation within the local real estate community can lead to more off-market deals and referrals. Consistent learning and adapting to market changes are also crucial for longevity. A sustainable business focuses on repeatable processes and scalable operations. Key elements for sustainability include consistent deal flow through diverse sourcing methods, robust financial management and capital reserves, a strong, reliable team of professionals and contractors, clear understanding of market cycles and risk management, continuous education and adaptation to new strategies. By establishing solid systems and fostering strong relationships, investors can transition from single transactions to a thriving, scalable business. This long-term perspective ensures that your investment activities remain profitable and resilient through various market conditions, building lasting wealth and financial freedom.